At a $135 entry price and an implied valuation of $1.75 trillion, the SpaceX initial public offering is capturing global attention. Retail investors are pouring in, viewing the stock as a direct stake in interplanetary colonization and the future of human spaceflight. But the financial mechanics operating beneath that narrative tell a different story. To understand what this asset actually is, you have to read the S-1 prospectus document. The financial data characterizes SpaceX as a highly leveraged artificial intelligence compute infrastructure holding company. The IPO aims to pull $75 billion in fresh capital from public markets. This flowchart tracks the capital. The immediate priority of this $75 billion raise is extracting liquidity to execute a $20 billion bridge loan repayment. That $20 billion specifically covers 12.5% high-interest private debt belonging to two separate entities, the X platform and X.AI. Structuring the offering this way creates two opposing gravitational forces on the stock, an extreme short-term liquidity squeeze acting against a massive long-term supply collapse. The immediate squeeze is engineered by releasing an artificially low 4.2% public float. With so few shares available to trade, early demand will heavily outpace supply. The long-term threat arrives in 2027, which is when the lockup period expires for billions of shares held by early private investors and insiders. The structure of this offering links the arrival of public capital directly to the repayment of debt held by the founders' separate private ventures. Analyzing the company's internal cash flow requires breaking down its three specific operational segments: traditional space launch, the Starlink telecom network, and artificial intelligence. The traditional space launch division maintains a total physical monopoly, successfully delivering over 80% of the world's orbital payload mass. Yet, despite controlling the global launch market, the aerospace segment operates deeply in the red, recording a $657 million loss in 2025. This comparative bar chart shows where the cash comes from. Starlink is the true revenue engine, generating $11.38 billion, with a massive 38.8% operating margin. That profitability was stable until the integration of X.AI and the construction of the Colossus data center. Building that infrastructure required $12.72 billion in capital expenditure during 2025 alone, a cost that swallowed Starlink's operational profits. Looking at the first quarter of 2026, the spending accelerates, with capital expenditure projected to exceed $10 billion in a single 3-month period. Because the AI arms race burns through the telecom segment's profits entirely, the combined entity recorded a $4.93 billion GAAP net loss. Evaluating this business on traditional aerospace metrics is no longer mathematically viable. The deeper mechanics of the S-1 filing outline the specific rules governing how incoming cash is handled. The document includes an explicit mandate. The newly raised IPO funds must be used to prioritize the repayment of that $20 billion bridge loan within 6 months of listing. This clause legally transforms the incoming retail investment capital into a direct repayment fund for private M&A debt. The corporate governance structure is equally rigid. By utilizing Class B shares, the founder retains 84.4%. Both agreements include a 90-day unconditional termination clause. If Google or Anthropic complete their own data centers, they can legally sever the agreements, and that projected revenue will instantly vanish. Public shareholders are entering a dictatorial government structure, absorbing maximum financial risk for AI contracts that could be legally dissolved in a single quarter. We also have to price this asset against the broader macroeconomic environment. The federal funds rate is currently hovering between 3.50% and 3.75%. Persistent inflation has removed the possibility of near-term rate cuts, meaning capital remains expensive across the broader market. Looking at this comparison of price-to-sales multiples reveals how aggressively the IPO is priced. While bleeding cash, the company is demanding a 94.7x multiple. The traditional aerospace and defense sector trades at a fraction of that, usually between 2.5x and 3.1x. Even the pure-play AI industry leader, OpenAI, commands an estimated multiple of roughly 42x. This public offering requires paying more than double the premium of the top private AI asset. Institutional models provide a baseline here. Morningstar's discounted cash flow analysis estimates the company's true fair value closer to $780 billion. Entering at a $1.75 trillion valuation in a high-interest environment leaves zero margin for error. The company must execute the total defeat of OpenAI and establish a profitable Mars logistics network just to mathematically break even on the current price. This massive public offering forces a structural capital shift across the founder's entire corporate ecosystem. Institutional portfolio managers operate under strict allocation limits. To deploy billions into the new SpaceX IPO, they must free up capital by selling highly liquid adjacent assets, triggering a massive liquidity drain, primarily targeting Tesla shares. The market narrative links the two entities through technical convergence, specifically the Terafab Chip Alliance and the MacroHard Proxy AI platform. This introduces a severe governance risk for Tesla shareholders. The core artificial intelligence intellectual property is being hoarded within the newly public SpaceX, leaving the automotive company functioning as a hardware supplier. Buying into this ecosystem means accepting that the SpaceX IPO actively cannibalizes both the available capital liquidity and the future technological upside of Tesla. This chart maps three distinct stock price trajectories based on institutional data, the float squeeze, and lockup expirations. The immediate bull case targets the $200 to $220 range, pushing the market cap past $2.5 trillion within the first 2 weeks of trading. This is driven by mechanical market structure. The tiny 4.2% float, combined with retail allocation and dark pool premiums, severely restricts supply. When NASDAQ and MSCI execute fast entry mechanisms, passive index funds are forced to buy regardless of price, creating a concentrated short squeeze. The base case sees the stock stabilizing between $135 and $160 as the market waits late 2026 earnings. The inevitable bear case maps a plunge to the $60 to $77 range, correcting the market cap back to the $780 billion reality. This drop triggers in 2027, when 4.7 venture capital shares unlock and flood the market. If competitors execute their 90-day contract terminations at the same time, the extreme 94x sales multiple will likely adjust to meet private market baselines. The life cycle of this stock operates as a binary trap, an immediate, mathematically driven liquidity pump, followed by a probable structural collapse once the insiders are free to sell. Operating in this asset requires strict objective discipline. Short-term momentum traders should focus on exploiting the forced index buying during the initial 15-day liquidity squeeze. If you participate in that squeeze, execute strict profit-taking targets. Under no circumstances should you hold this asset long-term at its current inflated market cap. For long-term value investors, the optimal strategy is absolute discipline. Watch from the sidelines and refuse to buy into the initial public offering. A mathematically sound entry requires waiting until after the Q1 2027 lockup crash. Ensure the market capitalization drops below $1 trillion, and verify compute contracts survived the 90-day window. Surviving this IPO means completely ignoring the romanticized narrative and strictly defending your capital against a highly leveraged corporate balance sheet. For deep dive U.S. stock and market analysis, remember to like, subscribe, and share Calling Monster Finance.